In today's video, I am going to be breaking down 5 Canadian ETFs that have an extremely high dividend that you might like. Some of these are a little bit more riskier than others. However, let's get down and let's check these out. The first one I am talking about is ZWK. It's the BMO Covered Call US Bank ETF, and yes, I do own a couple of shares of this, quite a few shares actually, because it has currently a 7.2% dividend. However, I was purchasing it back when that huge dip happened during the COVID recession, where it actually ballooned up to well over 10 and close to 11%. So since then, it has fallen mainly because the stock price has gone up. And there's a reason why I'm picking this one out, specifically number 1. While yes, I have spoke about this a lot in the past. However, this ETF is actually very interesting right now because there's a big dynamic shift in the market and how people are starting to invest. Because there's a lot less cheap money out there, where are people starting to invest their money? In blue chip dividend stocks. What does that mean? Banks, and banks specifically have been doing actually not too bad. American banks haven't been doing as well as Canadian banks recently, even though as of the day of making this video, Canadian banks, some of them are down by a huge margin. However, overall, this is where a lot of the money seems to be starting to go. The MER is 0.71%, which is high for an ETF, but it is a covered call ETF. Now, really quickly, what a covered call ETF really is when you hold shares of whatever stock you have, and you're basically selling a call option against them, basically playing like a casino, where if they hit a certain stock price, then whoever purchases that call option can purchase those shares at the time of making that call option. However, at the same time, usually that strike price doesn't happen, especially when it's a BMO covered call. They usually put them well out of the money, which means that you get to keep your shares and you can be like a casino and keep the call option premiums, which is why the yield is so high. The average volume is also not too bad at 24,000 shares traded on average every single day. Now, this is not a very old ETF, but it did slightly rise before this whole pandemic hit, and since then it has accelerated above that previous all-time high, which was just over or around $33-ish a share. Now well over 33, at least by a fairly good margin. Something else that I really want to point out with every single covered call ETF, no matter how new or old they are, is the volume. Since this COVID pandemic hit, volume has been generally pretty big. People are going after the yield. However, since then, that volume has either accelerated with some or leveled off to be roughly the same amount since then, this year specifically too, which is kind of interesting. Now, they did recently lower their dividend. It's because there's not as much market volatility, and that is the main reason why you will see a lot of covered call strategies start to peter off their dividends slightly, but they will always be higher than an average dividend on the market. These are the top banks that this ETF does hold. ZWK holds Goldman Sachs right now as their number 1 holding. Bank of America. These tend to move around quite a bit with this ETF, so keep that in mind too. The second ETF is FHI. It's a healthcare giants covered call. All of these, by the way, are going to be covered calls, just so you know. However, with this one, FHI, you are getting an 8.6% yield and an average volume right now of 12,000 shares per day. Again, higher MER than average as well, but again, it's because it's a covered call. Now, why would I mention this ETF at this point in time? Of course, it does have a high dividend, well, high yield. You have to remember that these are taxed slightly different than average dividends. However, when it comes to healthcare, there's going to be a lot of investment into there, especially in Canada, because guess what? The government's messed up huge, and they need to start investing eventually. At least if they were smart, they would start investing right now into healthcare. And this is one of the ETFs that holds quite a few healthcare stocks. pretty much all of them. And even the Americans are pressuring their government into spending more money into the healthcare system. So because of that, I think that this could actually be a good play, at least this year. Again, not a very old ETF, since 2018. However, we did see that drop just like everything during that major pandemic, just everyone ditching everything at once. And of course, anytime you see this, you really need to buy, because anytime where people are saying the world is burning, it's usually a lie. And because of that, it has accelerated, not just because everything has recovered. We can see that this is actually a pretty solid recovery, pretty well in line. It's right in the middle of its trend. This is a pretty solid play if you wanted to sort of get into it right now and then wait to see what happens into the future. So this one again is about a quarterly dividend, and when we start comparing year over year, we can see that recently there was a little bit of a decrease year over year on the dividend. However, it's still higher than the year prior, so keep that in mind. I don't think that they'll be going down to these levels. There's still some pretty big market volatility, so still a pretty solid dividend. Its top holdings are going to be Abbott Laboratories. We all know that these are very solid companies to be investing in right now, especially United Health Group, HCA. I think those are going to be fantastic companies going into the future. And of course, there is Merck, and they are going to be very solid companies, especially when there's more healthcare spending happening eventually at the government level. We have to remember that when it comes to government spending, they tend to get screwed by companies who are receiving that money, because of course, what happens? Oh, it's the government. They have unlimited funds. Give me every penny that you have. That's how companies work. And if I ran a business that was dealing with the government, I would do the exact same thing. The next ETF I have spoke about as well, TXF. This one is a tech giants covered call. Again, we're going with that covered call idea. The yield on this is 10.7%. 0.71% MER, and the volume is 44,000 shares traded per day. Now, the reason why you really want to look at the shares and number of shares being traded is because, of course, when it comes to volume, if you're trading 30,000 shares and that stock is only, or that ETF is really only trading at 10,000 shares, it could take you a couple of days to get in and out of it. So keep that in mind. But generally speaking, when you're looking at 44,000 shares, you're not going to really have an issue at $21 a share. But either way, what this one may be good for is maybe a few months from now, once this whole tech sell-off finishes, at that point would be a good time to get in potentially, because there's always going to be growth when it comes to tech. Over the past 5 years, we've seen it go from a very low amount of around $12.50 up to where it is now at $21 per share. And when we go to a chart that's even further out, way back in 2012, it was trading at $10. It's doubled since then. And of course, you're getting that massive dividend. If you were to reinvest during this whole entire time, it would be fantastic. And even if you weren't, you could use it as an income supplement very easily. We can see that they've been paying pretty massive dividends. And if you look at year over year, from here to here, we can see that there was a drop. That is again because there is less market volatility. However, if we look versus 2019, or even 2018, that they tend to fluctuate, but you're still getting a very solid dividend throughout. Its top holdings are some of the most highest growth names in tech that are very solid companies. AMD, I wish I still owned that company. I owned it way when it was well under like $3 or $4 a share, and now look where it is. However, very solid companies. The only one I would really say as bad as Qualcomm, because of course there's always companies that are trying to beat them up. Otherwise, very strong portfolio. This next one is Ethy. Oh my gosh, look at that dividend. Ethy, when I was at the beginning of the year mentioning this, of course we have to remember that Ethereum has gone down. However, the dividends so far have stayed the same as far as we know, because guess what? We haven't had a dividend since the last time they mentioned it, which really isn't that long ago, because they're paying right now, according to their website, they will be paying a dividend every single month. Now, keep in mind, their actual ETF prospectus, or however you want to call it, I probably didn't pronounce that right, but either way, what they say the ETF is, they don't promise a monthly dividend distribution yet. Here on the actual website, they do promise it. So, yeah, keep that in mind. Either way, as of right now, versus for the last dividend that they gave out, the last distribution was at a massive percentage, and if that does continue, if you were to buy it today, you would be at 25%, which means that if you were to invest $1,000 into it, you would be making $250 a year, which is insane. Hopefully, Ethereum and other cryptocurrencies like Bitcoin continue to go up, because right now they've been tanking. The management fee is 1.1%, so it is a bit higher. However, when you look at the distribution, it doesn't really matter. Now, here is the portfolio breakdown. 98% is Ethereum, and of course 16% is covered calls. So why is this important? This right here is important because, let's say for example, the covered calls hit the strike price. Let's say the price of Ethereum has gone up through the roof. Well, guess what? That would mean that you may lose up to 16% of your portfolio, which would suck. Now, will that happen? I haven't been able to find out where their strike prices are, so at this point in time, from my very minimal amount of research I've done on their covered calls that they have out, which I cannot find. However, what we do have here is that they do have 1 month and 1 to 3 month expiry dates on their call options. So this does give a little bit of hope that potentially, that at least right now, those strike prices will not be reached because of the massive decline in the stock price of Ether, whatever you want to call it. These are its 2 past dividends. Now, this probably would have shown up in your account as one single dividend, mainly because that's what's happened to me with other ETFs in the past. I get confused when it shows up as one, and then you have to break it down when you get your little paper mailed to you. But either way, capital gains is taxed differently than a regular dividend, so keep that in mind. BTCY is the next one. This is another interesting one. Instead of it being Ether, it's going to be Bitcoin. This one currently is at 16.5 to 16.75%, depending on if you get hedged or, of course, non-hedged, hedged, whatever. Either way, the one I currently own myself is this one. Same management fee on all of them. You can actually see the historical price of Bitcoin, and it looks like it may just be stabilizing a bit. It may start accelerating. Who knows? It's Bitcoin. Well, you can just never guess what Bitcoin's price is going to be tomorrow. This one has a fewer amount of covered calls out on the market, roughly same percentage of Bitcoin, so not too shabby in my opinion. Anything below 15% in covered calls on a covered call strategy is generally safe in my opinion. However, it's just hard to say because Ether and Bitcoin, they tend to fluctuate just so much. I hope that this video has helped you. If it has, hit that like button and subscribe. These are kind of interesting ETFs altogether. If you have also found that they were interesting, comment down below, and I'll see you guys again next time.